Okay, so this is going to be a video on Williamette Valley Vineyards. Small company, very small company. Um, Incorporated and executive office is located in Oregon, and trading on the NASDAQ capital market. And right here, you will also see something very unique. Series A redeemable preferred stock, the trading symbol WVVIP. So right now I'm going to pull up Williamette Valley Vineyards on a quick FS. The guys over at Focused Compounding actually showed me this site. So uh, I got it from them on their YouTube channel. Subscribe to them. They're fantastic. And right now, just the highlights very quickly. Last close, $6. Market cap, 33 million. Very, very small company with a share turnover of 27%. Right out the gate, it's trading at a low absolute price and then not trading really much at all. Share turnover is very, very low. Anything under 100% is apparently very low share turnover. And this is barely trading a few hands. Right out of the gate, you have a unique, rather illiquid stock. And it's a wine company, no less. And there's not that many publicly traded wine companies. There's a few publicly traded distilled spirit companies. There's a few publicly traded beer companies, but not a whole lot of publicly traded wine companies. It's a pretty rare thing to see in the capital markets, but it's there. And I happen to have found one, thankfully. So a little bit of history behind them. They were formed in May 1988 to sell premium, super premium, and ultra premium varietals. They were a sole proprietorship under Jim Burnau. He's still with the company, and they are south of Salem, Oregon, headquartered in Turner, Oregon. And the company also owns the Tualatin Estate Vineyards and Winery located near Forest Grove, Oregon. They operate under the label Griffin Creek, Tualatin Estate, Pambrun, Meissen Blue, Natoma, Metis, and Elton. They have two operating segments, direct and distributor sales. Direct sales including retail sales in their tasting room and remote sites, wine clubs, online sales, on-site events, kitchen and catering, and other sales made directly to the customer without the use of an intermediary. Distributor sales are all sales through a third party where prices are given at a wholesale rate. And they mention their products and their price points pretty in depth. So they're all 750 milliliter sized bottles, and the price points are around $14 to $75 per bottle. So they're not making the high premium kind of wines. They're making things that people would want to buy off of a bad day, and going to Total Wine and spending $20 on a way to forget their bad day. So they're doing something that's trying to be cheap and give you high quality, cheap on an absolute basis. I'm not personally familiar with any of their wines, so I can't speak to the quality. I'm not much of a wine drinker, to be quite honest. So I can't speak to the quality of their product on a personal basis. So right here, they're kind of being a little promotional. The market overview. A lot of these smaller companies, they'll be very, very promotional because they're thinly traded and they're small cap or micro, in this case, maybe even nano caps, trying to be promotional and hype up their company. Look at how we are related to the growth of the industry that we're in. And Williamette Valley is no exception. They mentioned the market overview here. From 2009 to 2020, wineries grew at a very large rate. And U.S. wineries increased production in 2017, the most recent year for such data, by 7.5% compared to 2016, according to the Wine Institute. So they're trying to back this up, this valid market overview data, with official sources, and trying to make their promotional efforts sound a bit more redeeming and verified, that you could pull up this information too and double check them if you so chose. Now, the United States is the largest wine market in the world. It's 15% of world consumption in 2017. Total wine shipments, U.S. Wine shipments were 409 million cases. They do everything in cases here. So it frames the discussion. And with total U.S. wine sales, domestic and import revenue of $72 billion, up nearly 4%, according to a Wine Analytics report. Wine sales have grown for 25 consecutive years. And at 644,647 locations in America that sold wine in 2017, an increase of more than 100,000 locations over the past 10 years, according to Nielsen. U.S. consumers enjoy wine with 240, continue to enjoy wine with 240 million Americans, approximately 40% of the adult population drinking wine in 2018, 56% of them being female, 44% being male, 33% of them drinking wine more than once a week. Domestic wine accounted for 67% of U.S. sales. The 5 most popular wines were all these brands over here, and I highly doubt I'd be able to pronounce them properly. So in 2018, off-premise sales were about 81% of the market, average bottle price of $10. I did not expect that. I expected it to be a little higher, but that was just me. Direct-to-consumer sales are the fastest growing channel in the U.S. market, but they're still very small, representing less than 2% of U.S. volume, and such sales increased by 12% in 2018 from 2017. 50% reported that they consume wine daily or several times a week. High-frequency wine drinkers, what an endearing title, with 17% reporting that they drink wine once a week, and the remaining 33% drinking wine less frequently. Red wine is the favorite for 69% of the sample group, and 67% like white wine more, and 40% listing rosé. Price and brand are the most obvious things that people look for. Americans compete on price and nothing else. When purchasing wine for home consumption at 80% and 69% respectively. Of those, 32% listed the most common purchase price being $11 to $15. However, 46% indicated that they have paid $50 to $99 a bottle for a special occasion. Here they mentioned baby boomers are moving into retirement and dying. Therefore, their per capita consumption is dropping. While younger generations represent a substantial opportunity, they have to make more dramatic adjustments in their strategies to reach and appeal to younger consumers with different values or face declining sales and profits. Okay, fine. We've seen this before in other companies. They gotta compete differently for millennials who are concerned about different things when it comes to alcohol consumption. Here they talk about the Oregon wine industry. It's a relatively new wine industry. And where does Oregon lead in wine? Planted acres of wine grape vineyards increased by nearly 2,000 acres from here to here, an increase of 5.8%. Oregon wine grapes produced a 2018 crop with a total value of $209 million, an increase of 8.7% from 2017. This brand lays all varieties, accounting for 57% of planted acreage, and 59% of production. Now, they mention a few other fascinating things because of climate, soil, and other growing conditions. Remember where Oregon is, it actually borders a major body of water, which will guide the climate, which will guide an incredible amount of how they have to grow their crop. Oregon only contributes 1% of domestic wine production. It accounted for 21% of domestic wines that garnered a score of 90 points or higher by Wine Spectator 5 years ago. They do have certain disadvantages as a region. Oregon's wines are not very well known. I mean, people really don't know Oregon for their wines. You think of California, Napa Valley, you think of their French competitors, which is weird. They compare themselves to another country. I wasn't expecting that. I was looking at them going, really, you think you're just competing with France in its entirety. They didn't mention any international companies in this report specifically. But it was just a very odd knee-jerk reaction of mine to look, oh, France, they think they're competing with France. Okay, that's odd. Finally, they mentioned that Phylloxera, they have a big problem with an aphid-like insect that feeds on the roots of the grapevines. And they mentioned that in 1997, they bought the Tualatin Vineyards at the Tualatin Winery, which has Phylloxera at its site. So they mentioned one of the biggest problems that they have to deal with is an insect that kills their crop. And all current plantings are with, and all future planting will be with Phylloxera with resistant rootstock at that location. So they are doing their best to make sure that this is not as big an issue as possible because it's going to destroy crop production and inventory. They mention the 2018 Oregon harvest. Pinot Noir, I guess that's how you pronounce it. Please tell me it's right. Continued to lead statewide production, representing well over half of planted acreage. And there's no official data yet on the 2019 Oregon harvest. They mention here the vineyards and their acreage and producing. They talk about it in terms of tons. To be very clear, that's how they frame the discussion. They're mentioning the vineyards and the estates that they've bought out over the past few years. They mention here something very fascinating. I just found this really intriguing. Oregon's Williamette Valley is recognized as the premier location for growing certain varieties of high-quality wine grapes. The estate vineyards' grape growing conditions compare favorably to those found in some of the famous viticultural regions of France. Western Oregon's latitude, 42 degrees by 46 degrees north, and relationship to the eastern edge of a major ocean are very similar to centuries-old wine grape growing regions of France. I find that very fascinating to hear about. I never would have thought that a place in the U.S. would have mimicked that, however happenstance it may be. The estate vineyard soil type is Jory/Nekia. I don't know how to pronounce that. A dark reddish brown silky clay loam, noted for being of a high enough quality and suited to growing high quality wine grapes. The elevation ranges 533 feet to 800 feet above sea level, slopes from 2% to 30%, predominantly 12 to 20%. Average annual precipitation at the vineyard is 41.3 inches. Average annual air temperature is 52 to 54 degrees Fahrenheit. And the frost-free season averages from 190 to 210 days. So right out of the gate, they're giving a very detailed view of how to understand where they're growing their wines. And I like this level of detail immediately. They mention here that the Phylloxera that they deal with at the Tualatin Vineyard has been on the property in the southernmost section that they removed in 2004. The remaining vines and all others infested remain productive at low crop levels, and they are removing them as the company continues to grow. So they mentioned, we've known about it for a while. We're doing our best to get it out, and we're still being productive with the Phylloxera infested rootstock that we do have. Now they mentioned that they do have some mortgages on their properties. They have 2 mortgages with an aggregate principal balance of $6.4 million. The 2 outstanding loans require monthly principal and interest payments of this for the life of the loans at annual fixed interest rates of that, with maturity dates of 2028 and 2032. They can pay this off very, very quickly. They're just a very liquid company. No pun intended. Now, they market and sell their wines through mailing lists and through distributors and wine brokers. This has a very high impact on their margins, as they'll go on to mention. They mentioned that they have a unique location alongside Interstate 5. I never thought that a wine company would be bragging about being close to the highway, because you usually don't think of wine right off the highway. You think of Taco Bell and Wawa. I don't think they have Wawa out there. It sounds sad. The company offers a complimentary daily tour and so on and so forth. This is all pre-COVID, by the way. And they're launching the full-on wine experience with having their hospitality center and so on and so forth, being a tourist location. And they're right outside of some of their largest cities, right outside of Portland, Oregon's largest city and most popular destination. I imagine that's pre-riots, but who knows? Maybe you like violence with your wine. I don't know. Sounds about happenstance. The company believes a convenient location adjacent to a major highway enables an incredible amount of investors. The winery is approximately a 45-minute drive from Portland and less than 1 mile from the Enchanted Forest, an amusement park which operates from April through September each year. It's odd how they're framing this kind of product that they have in terms of leisure in the exact same way that an amusement park is leisure. But I guess that's the image that they want of you having, when you read this, you don't think wine and an amusement park together. But I guess they want you to view wine as fun in the same way as an amusement park, which is a unique way to look at it, and not necessarily a bad thing. They mentioned their revenue is concentrated. One distributor was 14.1% of their revenue, and it used to be 21% in 2018. They mentioned it's a very competitive industry. But no Oregon winery dominates the Oregon wine market. So they're still an open spot. Now, the current production level of most Oregon wineries is generally much smaller than the estimated production capacity level of the company's wineries. So they are producing greater than what the state actually needs, which could be great to grow into, but also presents a problem of productivity and being a little too eager to create quality wines. And excess capacity also has the bigger problem of how are they going to get off their books and so on and so forth. So this is a double-edged sword. A good problem to have, but still a problem nonetheless. Very small company, 132 full-time employees, 74 part-time, no unions, positive relations with its employees. Now, they do mention in the risk factors, their cash flow from operations has not been sufficient to provide all funds necessary for the operations. I mean, you could say that about any company, though. It's not too special, because most companies are funded through their working capital generated from their operations and maybe some revolving credit facilities, secured lines of credit, term loans, so on and so forth. I mean, this is just a different way of phrasing it. They mentioned they have outstanding long-term debt of approximately $6.3 million. They don't have anything under their line of credit for $2 million. They have notes payable to private parties of $1.5 million. They mention here the split of their wine growing area. While wine grape growing regions in the U.S. are divided into American viticultural areas, AVAs, and it's divided by the Alcohol, Tobacco Tax and Trade Bureau of the DOT, the Department of the Treasury, based on distinguishable geographic features. And Oregon wines are apparently high quality, so the AVA label is very is a standard. It's something that you want to have on your bottle, and some people are using it outside of Oregon because it's just a way to market it. It sounds official. And they mentioned that this is a problem for us because it reduces our competitive advantage, and we have to go after people that are using the Oregon AVA inappropriately and trying and stealing market share from us and trying to take cash away from us because they want the Oregon AVA to mean high true quality. And people are pulling away from their moat that they could deliver, that they could create using that brand. Now, they mentioned here contamination of the wines could harm their business. Increased regulation, of course, it's alcohol. It's highly taxed, and they mentioned here actually rather early on the tax levels. They are taxed accordingly based on how high their alcohol content is. If it's under 16% alcohol content, they're taxed at $1 per gallon tax rate. If it's greater than 16%, it's taxed at $1.57 per gallon, and then it provides a dollar tax credit per gallon for the first 30,000 gallons, and then it lowers going higher up to 750,000 gallons, and they get taxed at 0.535 cents. These modifications were extended into 2020. They paid a state excise tax of 67 cents a gallon, below 14% alcohol content, and 77 cents above 14%. So it's not cheap to do this. It's not cheap to do it at all. They mentioned taxes and the fluctuating levels of taxes to be a big risk for them. 2,200 common stock shareholders. So I have no idea who's holding this, but it has to be publicly traded at this point. I would not have expected a company at $33 million market cap to have that many stockholders. So it has that many stockholders, and the share turnover is low, well under 30% share turnover. So who's holding this is going to be a big question. They've paid dividends on their preferred stock that they've issued. They've issued a good bit of preferred stock at low rates. And I'll run to there for a quick second. The company's Series A preferred stock has a cumulative 5.3% dividend based on the original issue price, 22 cents per share. Now, they mention I'm going to move down a little bit. They mentioned the company's preferred stock has been issued to people that they believe are wine enthusiasts. It's a very specific company that's trying to give share ownership to a very specific group of people. They probably imagine that the same people that are interested in wine are the same people that are invested in the markets. Therefore, they're rich enough to have leisure time to enjoy wine. And it makes sense. When considering joint ownership, we believe these new shareholders represent approximately 9,000 potential customers of the company. So they are looking ahead. They are looking to grow the company rather aggressively with new customers, and this is the way to do it, by giving preferred ownership. They do sell grapes or bulk wine periodically, which is inventory that doesn't meet their standards or is greater than production targets, but that's not a material part of their revenues, which is good. Now, they do believe that cash flow from operations under their existing credit facilities and preferred stock program, it's not a one-off thing, will help them with their foreseeable liquidity needs in the short term. Now, they mentioned here on their liquidity and capital resources section of their 10K, they do have a line of credit with NW Farm Credit Services, and also a long-term debt balance of $12,000 with Toyota for the purchase of a vehicle. You don't see this kind of nitty-gritty with larger companies. They tend to just lump as many things together as possible, which I like the detail that this company does give. Now, the preferred shares are subject to optional redemption after June 1st, 2021 at the discretion of the board of directors, and the liquidation preference is calculated at the original issue price of $4.15 a share plus all accrued but unpaid dividends. The original redemption, if implemented, is at the original issue price of $4.15 plus a redemption premium of 3% of the original issue price. And they are current on their dividend obligations. Now here it goes down to the level of ownership. I found this also a little bit fascinating. There's not a lot of share ownership at the high part of the company. The executive board doesn't really hold a whole lot. 8 people hold 9.3% of the shares beneficially owned. But you can see here that James Burnau, the owner operator, it was founded as a co-partnership with Don Voorhees, although he doesn't seem to be involved with the company anymore. James Burnau owns 8.4% of the company, and then everybody else is less than 1% until you get to an activist investor by the look of it, Mr. Christopher Riccardi, owning 7.8%, and the rest of the directors and executive officers as a group own 9.3%. So there's not a whole lot of skin in the game for the executive leadership, and that's somewhat disconcerting. Now, as a wine company, they're going to have a large chunk of finished goods as their inventory that they're holding and aging. I guess they want to maintain high quality vintages. So obviously finished goods are going to be a higher part of the production of their inventory, and their inventory is held to FIFO. Their finished goods inventory is held to FIFO. Now, when you try to value this company, I should mention that they mention for works in progress and the winemaking parts of their inventory that they're held at the lower of value, the lower of cost, so it's not marked up. And inventories account for a very large chunk of their total assets and of their current assets. Now, I will point out something very unique, and what makes this company a little difficult for me to understand is that they capitalize their vineyard development costs. Okay, so that immediately stood out to me as, okay, I don't know why this is there. So I had to double check: is the company doing something rather frivolous with their accounting? It does turn out that you can capitalize vineyard development costs under uniform capitalization rules, UNICAP rules, as long as the vineyard has not produced a crop yet. So I double checked with their auditor right there, Moss Adams, and to see if they were actually good with auditing wine and beer companies. So this was the rudimentary way that I looked them up. Google being the paradigm of all things, and it turns out that Moss Adams actually does audit a lot of alcoholic beverage companies. So they do have experience in this industry. So I can at least sit back and go, okay, your auditor knows what they're doing. So they are capitalizing these costs properly. Capitalized means they turn the expense into an asset for those that don't know what that means. And it took me a little while to figure out what it means to capitalize something on the balance sheet. So what that does now is it destroys free cash flow. As you can see here, even without adjusting anything, and I do adjust for depreciation and these non-cash expenses, I try to take those out. Even if I don't do that, the company is still messed up in terms of free cash flow because they're putting it all back into developing the business. Now, I'll just do the rudimentary way that I calculate it, CFFO minus CapEx, and I can just even do this acid test of this is smaller than CapEx. I would add additions to vineyard development into additions to PP&E because that is property, plant, and equipment. So right out the gate, it's a negative CFFO number, but I will run through it. You get about negative $1.02 million. So they run a deficit of free cash flow. However, then you have to ask yourself, okay, fine, but what about working capital? And I will calculate working capital as accounts receivables plus inventories minus accounts payables. $18.02 million. Okay, so their working capital covers their debt, which I wanted to know. And because free cash flow at that point, if it's negative, how are they paying for their operations? Working capital covers their debt needs. And it's a very fascinating thing to actually see that play out because you usually see companies rely more so on free cash flow than working capital. Now, if there's any more interesting things that I do want to discuss. Their doubtful account allowance. This actually did worry me a little bit. The allowance for doubtful accounts is pretty large. It's actually grown 40 odd percent. So 40.88% to be precise. So now you have to ask yourself, okay, this is dangerous because they had one customer accounting for 14% of their accounts receivables, but their doubtful accounts has jumped 40% from 2018 to 2019. So you have to ask yourself how solid is your working capital when one customer holds so much of your accounts receivables. Now, before I finish this, I do want to mention once again how I kind of try to deal with understanding how they capitalize their assets to try to figure out the research process of is this okay to do. I simply did a very simple thing. Unicap rules. For wine companies because I've never seen a wine company before. So how do I deal with it? How do I learn? So I went to the IRS website and they have a wine industry audit technique guide PDF for easy access. So it actually talks to the auditors. This was how I figured out, look at the auditor and see what they do and see who they are. Jumping down to the exact page here. It mentions here on page, I'll provide the link for this up in the description. On page 8, it mentions guidelines for capitalizing and expensing vineyard establishment costs when UNICAP does not apply. If UNICAP applies, all costs are capitalized until the vineyard starts producing a crop. And they will mention that they do this. On page 22, the company regularly evaluates the recoverability of capitalized costs. They capitalize internal vineyard development prior to the vineyard land becoming fully productive. And then they amortize the crop on a straight line basis for the estimated economic useful life of the vineyard, estimated to be 30 years. And amortization of vineyard development costs are included in capitalized crop costs that in turn are included in inventory costs, ultimately part of COGS, cost of goods sold, excuse me. I'm going to keep looking at this company. I will mention that I do like this company. Their gross margins are fantastic. Going back to Quick FS, WVVI is the ticker. Because it's a beverage company, it enjoys large gross margins, but not very large ROIC or ROE. They are still growing, as you can see. They've mentioned that they are throwing all their free cash flow back into vineyard development and PP&E. But you do see revenue and gross margins growing from 2010 onward, and operating margins growing concomitantly as well. I'm going to keep an eye on this company. I'm going to continue looking at it and maybe doing more videos on this company as the company continues to release financial disclosures, so on and so forth. A disclaimer, I do not intend to create a position in the next 72 hours, neither long nor short. And this is all just general investing knowledge. This is not investment advice. You are to do your own due diligence. All investing comes with its own risks. Thank you for watching. If you like this kind of content, please subscribe to the channel. And I will see you hopefully in the next video. Thank you.